Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today on our show. As I mentioned in the first couple segments, this is going to be our last show for a while. We have a lot of stuff going on at the firm. Me personally, as you probably know, we've made an acquisition of another investment advisory firm, and we've more than doubled the size of our firm in the past couple of months, and we've got a lot of work to do there. We're still going to be producing a lot of content for our website, www.dlblain.com. We'll continue to produce some articles. I'll be traveling quite a bit over the next several months. We'll try to get some audio messages and some video in, but unfortunately we're not going to be able to produce the show as we have on a regular basis for the past over 4 years. So we hope that you'll visit the website, www.dlblain.com, and we'll try to keep some fresh content going there for you. All right, so today we want to leave you some timeless principles of investing for the next several months or weeks that will keep you going. We were talking about carefully considering using index funds for your investments. There are a lot of benefits to them. There's a lot of underperformance going on in the active management world. It doesn't mean that there aren't managers that have beaten their respective indexes. I mean, it's possible to find those. The question is it possible for someone to do it on a reliable and consistent basis? That's number one. There's no evidence that it is possible. And number two is, can you find them in advance? It's easy in hindsight looking at, say a Bill Miller of Legg Mason or Warren Buffett and say, look, see, that person did it. But could you identify them in advance is very, very difficult. With index investing, you're never going to be the superstar, but you're never going to experience the bane of active management, which is underperformance. So there are some areas, the designing of the portfolio and how you mix the asset classes together and looking for value out there. I'm not saying buy and hold, buy and bury your head in the sand, but we're asking that you consider carefully the virtues of a widely diversified index type approach. One of the things that we also want to leave you with here today is really encourage you to avoid what I consider the three classic mistakes of investing, and I'll cover the first two. Well, the first one really is kind of a no-brainer, is borrowing on margin. Borrowing on margin is really dangerous. What borrowing margin is, you're borrowing the money to go invest in stocks. Unlike buying a house, which you live in, relatively stable in value, over the long run, stocks do return, a nice return on average, not all the time, not every period of time, but on average. But when we say on average, it's the details behind on average that make margin investing extremely dangerous. If you take the market and say, well, the average has been, 10% return a year, it really masks the fact that every, 10 years or seems like every 5 or 6 years, you're going to have a 20, 30% decline in there. Well, if you're on margin, you're going to have to come up with the outside cash to replenish your account. So just stay away from margin. The number two big mistake we see is buying stocks that have gone way up, particularly those the most, the story stocks, the Apples, the Googles, the Tesla Motors, the Netflix. Now, it's one thing to buy individual companies that have gone down a lot, but that have a reasonable chance of recovering. But I see people all the time. In fact, just the other day, you got somebody emailing me, wanting to buy Tesla Motors after it had gone up like 600% in the past 6 months. Not a good idea to buy after a run like that. I'm not saying it can't go higher, but you're talking about a company that has no earnings, that in order to make that price is discounting all its earnings 20, 25 years into the future. That is a long-term investment. If I'm going to invest 20, 25 years in the future, I'm not going to put it all on a car company. I'm going to invest in the entire market itself. So don't make that mistake. The last mistake is trying to beat the market either through excessive market timing. It's one thing if you're heading into retirement and you start to reduce your exposure to the equity market in favor of the bond market, or at the depths of despair in 2008, if you adjust your equity allocation a little bit to buy some more equity, well thought out, part of your investment policy statement. That's not what we're talking about. If you have a well thought out investment policy statement that says, hey, we should be, at this percent equity, and, maybe you get a new job, you're making more money, and you say, well, now I can afford to take more risk, and you bump that equity exposure up. Or maybe you have start having children, or you lose your job and you cut that equity exposure back. That's not market timing. That is adjusting your portfolio to your own personal circumstances. What I'm talking about is someone that says, oh, well, I just know the market's too high right now and it's going to go down, and so I'm going to put all my money under the mattress in gold, whatever. That's what we're talking about. And more people have missed out on more bull markets than you can imagine. Now, granted, occasionally it works out. In our particular case, in our firm, we were fortunate in that we reduced our equity exposure prior to the 2008 market. Not all of it. I didn't have a crystal ball. It just worked out, that way. Now, sometimes we may be wrong, but reducing the equity exposure for someone because their risk profile has changed is not market timing. But stay away from the market timing aspects of investing. Well, that's a couple of principles we have for you to leave you with. As I mentioned already, it's going to be our last show for a number of weeks. We're not going to be able to do the show live. If you head on over to the website, dlblain.com, there's a wealth of information there, all of our archive shows. We're going to try to continue to produce some articles, some of the other advisors in the office, but we're going to be very busy with our acquisition of the new firm that we made, and not going to be able to make it in the studio for a while. But we hope you've enjoyed the show today. We've enjoyed doing it, and hopefully you'll be able to catch up on the web with some of the other things. So just remember, investing is a long-term venture. Don't take the short-term view and get caught up in all the media hype that goes on out there on a daily basis. So for All Things Money, I'm your host, David Blain, and we'll see you in the future.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.